You open your laptop, click one red button, and an invisible machine starts printing money. Not because you paid for a movie, but because Netflix already won years before you pressed play. Here's the uncomfortable truth most people miss. Netflix didn't become valuable because it made great shows. It became valuable because it figured out how to turn attention into a financial asset Wall Street could believe in. And once Wall Street believes in a story, the math stops mattering, until it suddenly does. This story matters right now because Netflix isn't just a streaming app anymore. It's a case study in how modern trillion-dollar ideas are built, how narratives outrun profits, and how an entire economic era learned to price growth instead of reality. To understand Netflix, you have to forget streaming for a moment. Forget actors. Forget binge-watching. Netflix is a capital allocation story disguised as entertainment. And it starts in a parking lot. In 1997, Reed Hastings returns a rented VHS tape late. The fee is $40. That annoyance sparks an idea, but not the idea people remember. The popular version says Netflix disrupted Blockbuster with DVDs by mail. That's only half true. The real disruption wasn't convenience, it was removing friction from spending. Blockbuster charged you every time you watched. Late fees punished you for forgetting. You had to think before consuming. Netflix flipped that. One flat fee. Unlimited rentals, no penalties. Once the payment pain disappeared, consumption exploded. That principle becomes the foundation for everything Netflix does later. But in the early days, Netflix is not a winner. It's a fragile logistics company burning cash to ship plastic discs. In 2000, Hastings famously offers Netflix to Blockbuster for $50 million. Blockbuster laughs. At the time, that laugh made sense. Blockbuster had stores everywhere, real revenue, real profits. Netflix had debt, postage costs, and a weird subscription experiment. But here's what Blockbuster didn't understand. They were in the retail business. Netflix was quietly building a data business. Every DVD shipped taught Netflix something. What you watched, when you watched, what you returned fast, what you kept. Blockbuster knew what sold. Netflix knew you. That difference compounds. By the mid-2000s, Netflix realizes something uncomfortable. Mailing DVDs will never scale to trillions. The margins are capped. The logistics are heavy. So Netflix does something most successful companies refuse to do. It cannibalizes itself. In 2007, streaming launches. It's terrible at first. Limited catalog, low quality, confusing. But the cost curve is different. No postage, no warehouses, no returns. Streaming turns Netflix from a logistics problem into a bandwidth problem. And bandwidth gets cheaper every year. Here's where the financial machine really begins. Netflix doesn't just stream content. It sells a promise to investors. The promise is simple. Spend aggressively now, lose money today, dominate attention tomorrow, profit later. That promise only works if capital is cheap. And for over a decade, capital is basically free. After 2008, interest rates collapse. Central banks flood markets with liquidity. Suddenly, money needs somewhere to go. Netflix becomes the perfect destination. Why? Because Netflix isn't judged like a normal company. Traditional businesses are valued on profits. Netflix is valued on subscriber growth. Every new subscriber is treated like an annuity, a future stream of cash. As long as subscriber numbers rise, losses are forgiven. Actually, they're celebrated. Burning billions becomes a sign of ambition. Here's the uncomfortable math most people ignore. Netflix spends money before it earns it. It pays for content up front, years before it knows if anyone will watch.
Those costs go on the balance sheet as debt. For a long time, Netflix runs negative free cash flow, billions in the red. But Wall Street doesn't panic because growth is smooth, predictable, global. At its peak, Netflix adds tens of millions of subscribers per year. Each addition reinforces the story. More subs means more data. More data means better recommendations. Better recommendations mean less churn. A flywheel forms. But flywheels don't spin themselves. They require fuel. Netflix's fuel is debt. By the late 2010s, Netflix owes tens of billions of dollars. Not because it's failing, but because it's winning the growth game. Here's the irony. Netflix becomes successful by acting like a tech company, but its cost structure starts to look like Hollywood. Content is expensive, hits are unpredictable, failures are constant. For every Stranger Things, there are dozens of shows you forgot existed. Netflix hides this volatility behind scale. If one show fails, the machine keeps running. But scale cuts both ways. As Netflix grows, expectations grow faster. Wall Street stops asking, "Can you grow?" It starts asking, "Can you grow forever?" That's a dangerous question. By 2020, Netflix is everywhere, in almost every country, on every device. The pandemic accelerates everything. Subscribers surge, stock price explodes. At one point, Netflix is valued like it might never stop expanding. This is where the trillion-dollar idea takes shape. Not because Netflix reaches $1 trillion, but because it behaves like companies that do. It's priced on narrative, global dominance, cultural relevance, infinite content. But here's the hidden mechanism. Netflix's model depends on one fragile assumption, that subscriber growth will always outrun content costs. As long as new users arrive faster than expenses rise, the story holds. But growth is not a law of nature. Markets saturate. By 2022, something cracks. For the first time, Netflix loses subscribers. Not many, but symbolically, it's catastrophic. The stock collapses. Because Netflix isn't just losing users, it's losing certainty. Suddenly, the math investors ignored matters again. What happens when growth slows but costs don't? Content obligations remain. Debt remains. The flywheel doesn't reverse. It grinds. Netflix responds fast. Ads, password crackdowns, price hikes. Moves that would have been unthinkable during the growth at all costs era. This is where hype meets reality. For years, Netflix said ads were unnecessary, that subscriptions were pure, that passwords were harmless. All true until the numbers changed. Now, Netflix behaves like a mature utility, extracting more value from the same audience. Ironically, that's what Blockbuster used to do. The difference? Netflix has global scale and data gravity. But the uncomfortable question remains. Was Netflix ever $1 trillion business, or just $1 trillion idea? Its real achievement isn't content. It's teaching markets how to price attention. Netflix proved you can lose money for years, as long as you convince investors the losses are strategic. That lesson spread everywhere. Uber, Spotify, DoorDash.
Entire sectors run on the Netflix playbook. Cheap capital, aggressive expansion, deferred profitability. Netflix didn't invent this system, but it perfected it. Now zoom out. Interest rates are higher, capital is cautious, growth is harder. The environment that created Netflix's valuation no longer exists. The company is still powerful, still profitable, still dominant, but the rules have changed. And here's the unresolved part. If Netflix were founded today, with today's rates, today's competition, today's skepticism, would the story ever be believed? Or was Netflix a once-in-a-generation alignment of timing, technology, and monetary policy? That's the real question. Because the next trillion-dollar idea won't look like Netflix, but it will rely on the same fragile thing: a story strong enough to suspend disbelief until the math catches up again.